Before we dive in, the standard but important reminder: everything we discuss on this show is strictly for educational and entertainment purposes. The practice investment of the day is a simulated trade using no real money whatsoever. I am not a licensed financial advisor, and nothing in this episode constitutes financial advice, investment recommendations, or solicitations to buy or sell any security. Past performance does not predict future results. Markets involve the risk of loss. Always do your own research and consult a licensed financial advisor before making any investment decisions. The host and NARA network have no fiduciary relationship with listeners. Let's start with the market reaction that dominated the tape today. Stocks jumped and oil eased after President Trump said Iran is talking with the United States, even though Tehran quickly denied the claim. This is a classic example of how geopolitical headlines can create rapid sentiment shifts across global markets. The S&P 500 closed at 6,623, up a solid 1.8% on the day. The NASDAQ Composite finished at 22,087, gaining 2.0%. While the TSX Composite ended at 31,809, rising 1.6%. Those are meaningful daily moves, especially when they're driven by de-escalation hopes rather than fresh economic data. The relief stems from a reported 5-day pause on potential strikes against Iranian energy infrastructure. That pause immediately eased pressure on oil prices and lifted equities broadly, particularly in sectors that suffer when energy costs spike or when risk premiums rise. Canadian investors should pay close attention here because the TSX remains heavily weighted toward energy and materials names. A sustained drop in crude can weigh on those sectors while simultaneously supporting consumer, technology, and industrial names that benefit from lower input costs and reduced uncertainty. We also saw the US dollar lurch lower on the news, which adds another layer for anyone holding CAD-denominated portfolios. Commodity-sensitive sectors and the loonie itself often move in tandem with these types of geopolitical relief rallies. The key takeaway is that when headline risk drops quickly, the market reprices almost instantly. Sitting on your hands during these moments usually means leaving alpha on the table. That's exactly why we're devoting today's strategy spotlight to catalyst-driven sector rotation on geopolitical relief. This is one of the more practical modern techniques that used to be reserved for hedge fund desks, but is now accessible to any investor with a commission-free brokerage account. The strategy is straightforward in concept, but requires discipline in execution. When a major geopolitical catalyst materializes that clearly reduces tail risk, you rapidly reallocate a portion of your portfolio away from defensive commodity-heavy sectors and toward broader market or consumer-facing sectors that perform better in a lower uncertainty environment. In today's case, Trump's announcement of talks with Iran and the 5-day hold on strikes against power plants triggered exactly that kind of relief. Oil eased, equities rallied, and the rotation window opened. The approach starts with monitoring headline risk in real time. You don't need to be a geopolitical expert, but you do need to recognize when the narrative has shifted from escalation to negotiation. Once that shift is confirmed, the playbook is to reduce exposure to energy and materials while increasing exposure to technology, consumer discretionary, or broad market ETFs. Here's how you might implement it in practice. Using a brokerage screener on either Questrade or Wealthsimple, you can quickly flag any energy-heavy holdings in your TFSA or RRSP. If oil prices ease more than 2% on de-escalation news, you might rotate a 10 to 15% sleeve of the portfolio into a broad market ETF like XIC or a technology-focused ETF. The historical sweet spot for this type of rotation is the 24 to 72 hours following major geopolitical pauses before the market fully digests and prices in the new reality. Of course, no strategy is without risk. The biggest danger is a rapid reversal if the talks collapse or new information emerges that reignites tensions. That's why position sizing is critical. I recommend limiting any single rotation to no more than 5% of portfolio risk, using tight trailing stops, and being prepared to exit if the original catalyst deteriorates. In Canadian tax-advantaged accounts like a TFSA or RRSP, these moves can be executed in just a few clicks without triggering superficial loss rules or complicating your adjusted cost-based tracking. The edge comes from acting inside that narrow window before the broader market fully adjusts. Professional traders have been doing this for decades. The democratization of real-time news, low-cost execution, and powerful screeners now puts the same toolkit in the hands of retail investors who are willing to develop the discipline. Rotating successfully also depends on excellent trade execution, which brings us to an important practical lesson later in the show. But first, let's turn news into an actionable simulated trade. Speaking of turning headlines and corporate actions into real portfolio decisions, here's our practice investment of the day, a clean corporate capital recycling story on the TSX. Remember, this is a simulated weekly hold using no real money. It's purely an educational exercise to demonstrate analytical techniques. Today's pick is LGD, Liberty Gold Corporation on the TSX. The strategy here is an asset monetization play. The company has announced the sale of its non-core Gold Strike project for total consideration of US $72.5 million. That cash infusion provides fresh capital to accelerate development of its flagship Black Pine Oxide Gold project in Idaho, which is the higher priority asset in the company's portfolio. From a fundamental perspective, this is the kind of balance sheet catalyst that junior miners need to survive and thrive. Instead of constantly diluting shareholders through equity financings, the company is recycling capital from a non-core asset into its best project. Canadian investors in the resource sector should train themselves to look for exactly this type of use of proceeds language in press releases. Technically, on the daily time frame, the stock is sitting near its 200-day moving average, which often acts as a gravitational point for junior resource names. We expect volume to exceed the 20-day average on this news, providing confirmation that the market is paying attention. Nearest support sits at the recent swing low, while resistance is clearly defined at the 50-day moving average. For this simulated weekly hold, I'm suggesting an 8% stop loss below entry to keep the maximum acceptable loss within prudent risk parameters. The target range is between plus 4% and plus 9% by Friday's close. My confidence level on this idea is medium. We have two clear factors aligned, a concrete monetization catalyst and fresh capital being directed to the flagship project. That is partially offset by the typical execution uncertainty that comes with all junior mining stories and the fact that we don't yet have volume confirmation. The educational value here goes far beyond whether this particular simulated position wins or loses by Friday. The real lesson is learning to evaluate corporate capital recycling events rather than simply chasing raw commodity price moves. When you see a company selling an asset at a decent valuation and explicitly stating that proceeds will fund higher return projects, that's a repeatable edge if you can read the press release carefully, compare the size of the cash infusion to the company's market capitalization, and act while the news is still fresh. We will track this simulated weekly hold all week and give you a full debrief on Friday, including performance relative to the S&P 500, NASDAQ, and TSX Composite. This disciplined approach is exactly what separates investors who outperform index funds over time from those who simply ride commodity cycles. While we're on the topic of corporate actions and shareholder decisions, a quick but important note from the proxy advisory side. Glass Lewis has endorsed Aptos's plan of arrangement. For Canadian investors who find themselves holding shares in companies undergoing mergers, acquisitions, or plans of arrangement, this is a perfect example of why proxy advisory reports matter. Glass Lewis and ISS provide the same analytical framework that institutional investors use when deciding how to vote. Retail shareholders can usually access summaries of these reports through company filings or through certain brokerage research portals. Taking a few minutes to review the circular on SEDAR Plus or your brokerage's corporate actions section can make the difference between voting in favor of a deal that fairly compensates shareholders and inadvertently approving something that transfers value away from retail. This is one of those quiet but high-impact areas where individual investors can level the playing field with institutions. Staying in the small cap and AI space, here's another encouraging example of AI delivering measurable business results rather than just hype. Now, Vertical announced the expansion of a cloud data migration engagement after using AI to accelerate delivery timelines. This is exactly the kind of real-world use case that separates companies that are actually generating revenue from AI from those that are simply attaching the buzzword to their marketing materials. While the specific platform is enterprise-focused, retail investors can track similar small-cap AI services companies by setting up alerts on contract expansion and scope increases. On TradingView, it's as simple as creating a price and news alert on TSXV now. The broader implication is important. AI is transitioning from experimental pilot projects to productivity tools that can measurably shorten sales cycles, reduce delivery times, and expand contract values. When you see a small cap company announce that AI helped them win additional scope on an existing engagement, it's worth paying attention. These are the kinds of micro catalysts that can drive outsized moves in the names that are actually delivering. A few more quick hits before we wrap up today's episode, each offering a practical takeaway. Bombardier received the requisite written consents to amend the indenture governing its 7.450% notes due 2034. For fixed income investors in Canadian corporates, successful consent solicitations like this often reduce near-term refinancing risk and can tighten the issuer's credit spreads. It's a quiet but positive development that improves the company's financial flexibility. Arbutus reported cash equivalents, and marketable securities of $91.5 million as of December 2025. Biotech investors should use numbers like this as a benchmark when screening for names with multi-year cash runways. In the current higher interest rate environment, a strong balance sheet meaningfully reduces the risk of dilutive financings that can destroy shareholder value. BlackRock CEO Larry Fink urged clients to stay invested amid volatility while flagging AI as a major reshaping force across industries. This reinforces a core rule for TFSA and RRSP portfolios. Avoid reactive de-risking during geopolitical noise. Instead, maintain core equity exposure and selectively add to secular themes like artificial intelligence that have multi-year tailwinds. DoorDash is launching an emergency relief program to help U.S. gig workers offset surging fuel costs. Investors in gig economy or consumer discretionary names should watch carefully how input cost volatility flows through to margins. It will be interesting to see whether programs like this become a competitive moat that improves driver retention or simply turn into a temporary expense that pressures profitability. Now, here's something that most retail investors get wrong, and I'll be the first to admit it cost me real money before I figured it out. Imagine you placed a market order for an energy ETF last week when Middle East tensions spiked. In the opening minutes, the bid-ask spread blew out from 3 cents to 18 cents. Your fill came roughly 0.4% worse than the last quoted price because buy-side liquidity evaporated as market makers pulled quotes amid headline risk. During geopolitical shocks, automated market makers and high-frequency participants often temporarily reduce size or widen spreads to protect themselves against adverse selection. That behavior creates exactly the kind of environment where retail market orders get poor execution. The US dollar also lurched lower on the pause news today, showing how macro flows can compound intraday liquidity effects. The professional solution is simple but requires discipline. Check the Level 2 order book or adopt a strict limit order only rule during the first 15 minutes after major headlines. The biggest mistake is using market orders into headline-driven volatility. Instead, set your limit order at or better than the 20-period volume-weighted average price and be prepared to walk away if liquidity is too thin. This small change in execution discipline can save you dozens of basis points over the course of a year, and those basis points compound. Before we wrap up, a quick tease for tomorrow's episode. We'll be looking at how AI-powered sentiment tools can help filter noise in small-cap contract announcements so you can focus on the ones that actually matter. That's it for today's episode of Modern Investing Techniques. You'll find links to all the resources, screeners, and tools we discussed on the resources page. If you're enjoying the show, please subscribe, leave a review, and share it with someone who wants to move beyond simple index fund investing. Thank you for spending part of your Monday with me. Stay disciplined, stay curious, and I'll see you tomorrow. Word count, 2,387, approximately 15.5 minutes at normal podcast pacing. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.